Hello, my name is Victor Brannon and I am a student in the Real Estate Finance course for the College of William & Mary's Flex MBA Spring 2020 semester. Traditional wisdom generally leads us to believe that the ideal scenario when it comes to real estate is to own all of our holdings free and clear to allow maximum flexibility. But what happens in a corporate environment where land ownership is not the primary objective of the business? In this presentation, we will ask the question, why own when you can lease back? We will answer this question by examining the aspects of sale and leaseback transactions, when they should be utilized, some of the considerations for entering such agreements, and a quantitative analysis of an example leaseback transaction. First, let's determine what constitutes a sale and leaseback transaction. A sale and leaseback is an arrangement in which a company sells its real estate asset and then leases back that same asset from a purchaser. In these transactions, the seller is generally a company who owns its real estate outright and intends to remain on the land to operate its business. The purchaser is usually a REIT or real estate investment trust or an institutional investor generally familiar with commercial real estate. Who would benefit from a sale-leaseback transaction? Operating companies who own their real estate outright and are not engaged in the trade or management of real estate in their primary business. An example of this may be a company who owns a large warehouse but only occupies a portion of that warehouse and does not want to serve as landlord for any unused portion. Other companies who may benefit from a sale-leaseback are those who do not have the resources to obtain traditional financing at attractive rates, or would like access to larger amounts of capital than are traditionally available in a lending scenario. So why would a company enter a sale-leaseback agreement? A sale-leaseback provides quick access to capital for companies with real estate assets that may simply be sitting on the books as long-term assets. This capital can be used for investment in more profitable aspects of the business or return to shareholders. Typical lending restrictions and bank covenants do not apply to sale-leaseback transactions. And even though they are selling the land, companies can retain long-term occupancy through favorable lease terms. Two of the types of leaseback arrangements that are commonly seen under these scenarios are an absolute net lease, which is similar to the triple net lease concept we discussed in our classroom discussions. In an absolute net lease, the tenant sells all of its land and the buildings and improvements located thereon. The tenant then pays rent, operating expenses, property taxes and insurance, and all interior and exterior recurring expenses related to repairs, alterations, or modifications. The typical term of an absolute net lease in this scenario is 15 to 25 years with renewal options that allow for a longer tenancy. The second scenario is a ground lease. Under a ground lease, the tenant sells only the land where its improvements are located. The negative to this scenario is that the only return to the seller is the value of the land and not the buildings or improvements. And so this is more advantageous in a scenario where the land holds the majority of the value of the real estate holdings of the business. However, this would allow the seller to continue to take advantage of depreciation on the buildings and improvements, but may require a separate account for demolition and remediation at the end of the lease term. These are generally longer term leases with a typical term of 75 to 99 years. The next two slides come from a presentation from CBRE, a commercial real estate broker that was provided to our company when we considered entering a sale-leaseback transaction. This slide shows some of the typical terms included in a sale-leaseback. Of particular note for our scenario was an assignments right provision, which allowed free assignment or sale of the business. We were also provided a sample transaction timeline that showed a total transaction time of 90 to 120 days from the original discovery phase through closing. Some of the positives and negatives to entering a sale-leaseback transaction. For sellers, sale-leaseback transactions provide the following advantages. It converts equity into cash, which the seller may put back into the business or invest in additional properties or other appreciable assets. Offers an alternative to conventional financing, where attractive rates or other terms may not otherwise be available. It improves the balance sheet and credit standing, including liquidity ratios of the seller, by providing a cash infusion at the time of the sale. And some of those debt restrictions and bank covenants that could lead to default in normal lending scenarios do not apply. Some of the cons are loss of residual property value. The seller locks in the value of the land at the time of the sale and does not take part in the theoretical appreciation of the value of its real estate holdings during the time of the lease. There's also a loss of flexibility, and if the seller outgrows the property involved in the sale-leaseback transaction, they may not be able to freely move due to the length of the lease entered. While a positive to the sale-leaseback transaction is that lease payments are regular and predictable, those high rental payments may be outside of the scope of normal costs associated with the business and may reduce returns. From the buyer side, the pros are a higher return rate related to commercial real estate transactions than if they were to provide capital or utilize their capital in a traditional lending or investing scenario. Also, they have a built-in tenant who has a long-term interest in occupying the land. On the negative, there is some level of required property management, even though the seller retains most of the maintenance and upkeep on the property following the transaction. When determining value to be received in a sale-leaseback transaction, a traditional appraisal may be used to determine property value. However, in the commercial context, due to the uniqueness of the land and the improvements in their relation to the operations of the business, a true comparable property may be hard to find. So a second option, determining the value based on annual lease payments and utilizing cap rates to determine the property values, is usually more effective. The cap rate is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. In this slide, we'll take a look at an illustration of an example company who holds 3 sites. Based on comparable rental return rates, the total rent for the company would be $1 million annually. When we apply a cap rate, when we take a look at the applicable cap rates to similar properties in a geographical area, we believe that the cap rate will fall between 6 and 7.5% on the seller's properties. For the purposes of this presentation, we will identify a cap rate of 6.25%. In order to determine the total value to be paid for the real estate, we convert the cap rate to a rent multiple. By dividing 1 divided by the cap rate, the multiple in this scenario is 16 times rent, for a total return to the seller of $16 million in sale proceeds. Now that the seller knows that they'll be receiving $16 million, they must determine whether the sale-leaseback provides a financing option better than the other financing options available to the seller under regular lending scenarios. Noting that regular bank lending comes with covenants that the business will need to comply with in order to maintain the loan related to their balance sheet performance and liquidity. Additionally, banks are unlikely to lend based on the total value of the property and instead will apply a loan-to-value ratio. They must also note that at the end of the sale-leaseback term, the seller no longer holds the property and a lease extension must be entered to maintain the use of the property. There are some additional considerations related to taxes and balance sheet impacts that we will also explore later in this presentation. This illustrates a comparison between the sale-leaseback and traditional bank debt in the form of a interest-free mortgage. In both scenarios, the lease term is 20 years and the note term are 20 years for an interest-only mortgage. We see that the proceeds in a sale-leaseback are $16 million. However, the proceeds received from the mortgage transaction are far smaller. Due to a loan-to-value on the property of 75%, the available funds in a loan are only $12 million. Less traditional closing costs and fees at 10%, the proceeds actually received by the seller are $10.8 million. We can then compare the total cost of capital over the life of the contract to determine whether entering a sale-leaseback is advantageous. Some of the tax considerations are that rental payments may be fully deductible when the sale-leaseback is an operational lease. Under a traditional lending scenario, only depreciation and interest are deductible, and these may be far lower than the full amount of the rental payments paid annually. When the company just continues to own its land, only depreciation is deductible. Also, if the company has held the property for a substantial period of time, they may be able to apply capital gains to any gains on the property at the time of sale. Balance sheet considerations. Sale-leasebacks result in off-balance sheet debt. This means that only the current lease payments are carried as a liability to the business, and the instant capital infusion from sale proceeds will result in excess cash on the balance sheet. The excess cash can be deployed for projects that may return greater value to the business or may be used to return value to the shareholders through a dividend or distribution. There are also some scenarios where leasebacks may provide additional opportunities. Sale-leasebacks can provide access to capital so an owner or shareholders can access cash from the business outside of their regular operating income. There is a unique opportunity for companies who may be positioning for a future sale of the operating business. This is where I became acquainted with sale-leasebacks as our company was taking a look at this scenario. In certain situations where real estate trades at a higher multiple than the subject business in the same industry sector, it may be advantageous to take advantage of splitting the real estate from the business, and this opportunity is referred to as arbitrage. Arbitrage is the purchase and sale of an asset in order to profit from a difference in the asset's price between the markets. Here we'll see a quantitative illustration of this arbitrage opportunity. In mergers and acquisitions, businesses are generally valued on a market multiple of the income generated. Income is usually in the term of EBITDA, or earnings before interest, taxes, depreciation, and amortization. Our example business has an annual EBITDA of $10 million. The market multiple applied in this market is 5 times EBITDA for a total purchase price of the business of $50 million. However, if we undergo a sale-leaseback transaction, the business will receive a purchase price for its real estate of $16 million. When we look at the M&A sale value following a leaseback, the EBITDA would be reduced by the annual rent payment of $1 million, resulting in a new EBITDA of $9 million. We then apply that normal EBITDA multiple of 5 times for a new business purchase price of $45 million, or $5 million less than the original total purchase price. However, that $45 million, when combined with the $16 million real estate purchase price, equals a total return to the business of $61 million, or an excess return of $11 million, raising the effective EBITDA multiple to 6.1 times. In conclusion, sale-leasebacks aren't for everyone, but for the right business, they can provide access to available capital outside of the regular financing market. Lease terms can be tailored to be advantageous to the seller while providing a built-in long-term credit-worthy tenant for the buyer, so the seller can stay on the land and continue to operate their business potentially in perpetuity. and a potential arbitrage opportunity exists for greater return in a business sale. Following references were consulted in the presentation. Thank you for your time.